Many times, investing may be condensed into a few clear rules that everyone can follow to make money. But success could be attained through both doing and not doing things. Our emotions can make the process more challenging. Although, buy low and sell high is a well-known maxim, human nature frequently leads us to act in the opposite way. As a result, it's crucial to create a set of golden rules that will guide you through the difficult times. Anyone can make money while the market is in a bull run. The people who prosper and thrive in turbulent markets are those who have a long-term strategy that works, though. Here are 10 golden rules of investing to follow to make you a more successful and hopefully wealthy investor. Before starting, don't forget to like and subscribe to our channel for more future updates. So let's start. Number 10. Stay in the game, have an emergency fund. In order to stay invested for the long term and to get through difficult times, you must maintain an emergency fund. Keep 5% of your assets in cash, advises Craig Kirshner, president of Retirement Planning Services at Stewart Estate Planning Wealth Advisors in Pompano Beach, Florida, because setbacks occur in life. The author says, it makes sense to have at least 6 months' worth of expenses in your savings account. It's likely that if you have to sell any of your investments during a tough time, you'll do it at a loss. If you have an emergency fund, you might be able to extend the time you spend investing. Cash should always be stored in cash, ideally in a certificate of deposit or high-yield online savings account. Number 9. Review your investing plan regularly. It's a good idea to regularly review your plan to make sure that it still suits your needs, even while it can be a good idea to develop a solid investing strategy and only make modest tweaks to it. Every time you evaluate your accounts for tax-related reasons, you could perform this. Clients should remember that their original financial plan won't be their last one, says Kevin Driscoll, Vice President of Advisory Services at Navy Federal Financial Group in the Pensacola area. At least once a year, you should review your plan, especially when major life events like moving, starting a family, or changing employment occur. Number 8. Understand everything you invest in. Avoid investing in a product you don't understand and make sure the risks have been adequately communicated to you before investing, says Chris Raleigh, founder and CEO of Harvest Returns, a fintech platform for investing in agriculture. Whatever it is that you are investing in, you must understand how it works. When buying stocks, it's critical to comprehend why doing so makes sense and when the stock is likely to perform favorably. You should consider a fund's performance record, costs, and other aspects before investing. Knowing how an annuity works and your rights if you're buying one is essential. Number 7. Avoid timing the market. Experts usually advise clients to avoid trying to time the market or make a purchase or sale at the perfect time, as is depicted in popular culture like television and movies. Instead, it is usually said that time in the market is more important than timing the market. The idea behind this is that you must stay invested rather than constantly entering and departing the market in order to generate significant profits. And this is what Veronica Willis, an investment strategy specialist at the Wells Fargo Investing Institute, advises. The best and worst days typically coincide with periods of market volatility, such as a bear market or an economic downturn. An investor would need to trade with expert precision if they wanted to be in the market one day, out the next, and back in the next. Making frequent purchases is typically advised by experts in order to profit from dollar-cost averaging. Number 6. Stay diversified. Maintaining portfolio diversification is essential for reducing risk. Having just a few stocks in your portfolio, no matter how well they have performed for you, is dangerous. Experts advise diversifying your investments as a result. Investors should consider diversification as an investment strategy, according to Mindy Yu, a former director of investments at Stash. You can better endure the ups and downs of the stock market by diversifying your holdings. The good news is that achieving diversity can occasionally be straightforward. An investment in a Standard & Poor's 500 index fund, which has hundreds of stakes in the top American corporations, will hasten the diversification of a portfolio. You can add a bond fund or other options, such a real estate fund, to further diversify your assets. These funds may perform differently depending on the situation of the economy. Number 5. Keep your investing discipline. Investors should continue to save over time, even if they can only do so in little amounts, under both challenging and good economic circumstances. If you continue investing regularly, you'll form the habit of living within your means while gradually building a nest egg of assets in your portfolio. The ideal vehicle for this discipline is the 401k, which automatically withholds funds from your paycheck without your permission. It's important to make prudent asset selections. Number 4. Buy when everyone is fearful. When the market is down, investors frequently sell or simply stop paying attention. But that's when the sales are at their peak. It is true to state that there is no other market where goods are offered for sale but no one wants to purchase them. As Warren Buffett famously said, "Be greedy when others are scared, and fearful when others are greedy." Once your account is set up, there is nothing further you need to do to continue contributing. Which is wonderful news for 401k investors. This setup keeps your feelings out of the game. Number 3. Stick to your process. The best investors create a process that is consistent and productive over numerous market cycles. Even if there are brief setbacks that cause you to doubt your skills, stick with the tried and true. The long-term buy and hold approach is among the finest investing strategies. For instance, you can regularly invest in stock funds in a 401k and hold them for many years. However, if the market starts to fluctuate, it could be easy to deviate from your plan, as you're temporarily losing money. In no way. Number 2. Think like an owner. Thinking like an owner, says Chris Graff, co-chief investment officer at RMB Capital. Keep in mind that you are investing not just in equities but also in businesses. While many investors treat stocks like a game of chance, those stocks are backed by respectable companies. Stocks are a sort of partial ownership in a company, and they are likely to go in the same direction whether the company is profitable or not over time. Being aware of your motivations when investing is a tip from Christopher Miser, CEO of Vivaris Capital in La Jolla, California. Do you make investments or bets? Investing includes a variety of activities such as valuation, fundamental analysis, and performance forecasting. Graff recommends ensuring sure the business is in good financial and competitive standing, and that the management team is robust and supportive of shareholder interests. Number 1. Never lose money. Let's begin by quoting the late, great investor Warren Buffett's first rule: never lose money. Rule number 2 says, never forget rule number 1. The advice from the Oracle of Omaha highlights how important it is to prevent losses in your portfolio. If your portfolio has more capital, it will be more profitable. Thus, a loss lowers your potential earning power. Naturally, saying, "Don't lose money," is straightforward. Buffett's rule basically argues that one should take into account an investment's disadvantages, in addition to its potential rewards. If the risks you are taking do not outweigh the possible profits, the investment might not be worthwhile. As a result, many investors are presently steering clear of long-term bonds. First, Buffett suggests focusing on the bad. Making the proper decisions and avoiding the wrong ones are necessary for effective investing. It's imperative to keep your composure in the face of all of this so that you can motivate yourself to behave morally even when it feels risky or unsafe to do so. This is it for today's video. What do you think of our video? Feel free to share your thoughts in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.